All right, hello and welcome to Camel Finance. I'm your boy Camel, and you won't have seen this video, but around a year ago, back in May, I posted a video that said our house price is about to crash. And in the end of that video, I concluded a couple of things. First of all, I concluded that unless we were to get some massive crash show up, which of course it didn't, and we know that now having moved forward a year into the future, then house prices would likely be okay for the rest of the year. I said if we got this big crash, then house prices would probably suffer in the short term. But at least for the remainder of last year, it was likely the housing market, the property market, would hold up okay. And of course it did. I also said next year, being this year, 2023, that we should be open to a recession. Now, I still think that's possibly coming at the end of this year or even early next year. I don't think we're quite there yet. But I said it's during 2023 that we might have to be more open to seeing a property crash. And in 2023, it's more likely that we will start to see the cracks appear in the property market. Fast forward to today, and I think those cracks are becoming more and more visible. So that's what I want to talk about today. I want to just essentially point at a bunch of cracks in the property market, at least from my perspective, and say, it looks to me like we should potentially be open to seeing a top in the property market come in and potentially a rollover and a decline in property prices. Now, I want to preface this by saying it's a very complicated situation. It's a very complicated thing to analyze and to have any real deal of accuracy over. But hopefully, once I've pointed out a few things for you today, you'll be able to see what I'm seeing. First of all, buying conditions for housing are at the lowest levels seen since the 80s. We have extremely poor buying conditions that tend to only improve after a recession. And as you know, we're not quite at the recession portion of the cycle just yet. So likely this is not going to improve. These buying conditions for property is not likely to improve until after we've had some kind of recession. Here we've got the Case-Shiller home price index adjusted for inflation. Now, again, it doesn't mean that this could not just be a dip that's about to reverse and move to the upside. It doesn't mean that, but undeniably, as it stands at the moment, this is starting to look an awful lot like the top for the property market has already come in, and it's starting to look and have all this familiar symptoms of the prior tops that we've seen in 2006 and 89. In addition to this, prices in the world's 46 leading prime real estate markets are falling for the first time since 2009. This is exactly what I'm talking about. We're starting to see the cracks appear. Again, it's too early to say for sure that the top is in and house prices are all going to decline. But like I keep saying, and like is going to be the theme of today, there are plenty of cracks in the system starting to emerge. And so here's the German house price index. It doesn't really matter whether you're looking at the UK, the US or Europe. It's the same trend that is prevailing here. And whilst again, it's too early to tell whether this is the start of something more serious or just a dip for the short term that will shortly resolve to the upside, this undeniably has the familiar symptoms of potentially more downside to come. Here in the UK, we've just had the biggest increase in mortgage defaults, i.e. people not being able to service their mortgage, since 2009. Again, starting to have a bunch of familiar symptoms to the last time we saw a large decline in the property market. Not only has the UK had the biggest increase in mortgage defaults since 2009, but they're also expecting them to rise further in the coming months. The findings come amid growing concern over the cost of mortgages and warnings that nearly 1 million homeowners can expect to see their monthly repayments for their mortgage jump by £500 or more by the end of 2026. So is another mortgage crisis brewing? Well, homebuyer debt to income ratios are now approaching 40% in the beginning of 2023, and this means that home buyers are now spending 40% of their gross income on mortgages and interest costs, which is the same level as 2006. Again, history doesn't repeat, but it does often rhyme. And you can see that today, that number even exceeds that of the housing bubble. So the combination of the inflation everyone has had to deal with over the past couple of years and the interest rate hikes making people's mortgages more expensive has put a lot of people into a tricky situation. But it's not just people that own their own home and have a mortgage on their own primary residence. Mortgage payments now are 58% more expensive than rent payments. Landlords here are paying 58% more than they are currently asking for in rent. This cannot continue. Rent is going to have to be adjusted upwards. So it's not just mortgage owners, it's not just property owners that are in trouble here. It is also the landlords and the people that are living in rental properties. Unfortunately, the cracks that we're starting to see in the system only get worse when we start to look at commercial real estate. How is anyone going to be able to afford to roll over their commercial debt at higher rates? Not to mention a whole bunch of people that own this commercial real estate are paying massive premiums on empty property. Remember, since the pandemic, an awful lot of people have been working from home. Remote working has become far more commonplace. And for many, many businesses all around the world, these commercial real estate holders cannot wait for their fixed rate term to come to an end so they can get out of their deal. They don't want to continue to pay higher rates, especially because an awful lot of people are working from home now. Needless to say, if these commercial real estate owners do not want to roll over the debt and pay a higher interest rate, especially for their empty office space, we're likely to see an awful lot of commercial real estate come onto the property market at the same time. And this chart here shows the commercial mortgage maturities up to 2027. You can see there's a vast number of mortgages that are set to roll over the coming years, all of which currently at significantly higher interest rates than they are paying today. Office buildings have surpassed malls in defaults. So like I said, with an awful lot of offices now operating remotely, with an awful lot of people having been sent home to work from home, and with the massive spike in interest rates, it's not just the standard homeowner that is defaulting on their mortgages, it is also the commercial real estate sector that is starting to default as well. There's also a third factor at play here, because as I've already said, the office owners are already dealing with high interest rates and vacant property due to the remote workers. But in addition to this, the banking crisis is slashing credit availability to roll debt and finance new debt. Triple B mortgage-backed securities have sold off to 0.69 cents on the dollar. And whether you know charts or not, whether you're a chart person or not, it doesn't take a genius to take a look at this and understand that, again, the cracks in the system are beginning to show. The Bank of England's credit conditions survey shows that the default rates on the corporate loans are expected to rise, mainly for small businesses, whilst defaults on mortgages to households have already gone up and expected to continue rising through Q3. So it's important to point out here, the more defaults we have, the more these properties will be forced to be sold on the market, the more we oversupply the market with forced sales. And as with any situation where you have an oversupply, prices tend to decline in order to try to find buyers. This whole commercial real estate problem extends even further because banks such as Wells Fargo are starting to report even higher losses in commercial real estate due to its office loan portfolio. Remember, the banks have massive exposure to this sector, and as these defaults continue, this is going to start to cause the banks a lot more pain. Hopefully you can see the dominoes are starting to fall. And so again, we continue to see these banks are under stress. Commercial real estate loans make up around 25% of total bank loans outstanding, but account for nearly half of all loans at community banks. We already know these banks have been stressed mostly from rate hikes, forcing their bond portfolio to sit in unrealized losses. And now on top of that, they might be about to suffer even more stress from commercial real estate collapses. And whilst that sounds like speculation, whilst I've worded that in a way that sounds speculative, this is already starting to become a reality. Take a look at this. Blackstone executive is celebrating crossing the $1 trillion threshold while they block investors from getting their money out amid commercial real estate crisis. So what stage of capitalism is this? Blackstone has limited withdrawals from the real estate income trust for the 7th straight month. They are preventing people from withdrawing because they do not have the money in the system. They cannot realize these losses without going broke. So is there light at the end of the tunnel? Well, of course, the longer we go on hiking rates, and the Fed has even started to pause rates in America, the closer we likely are to seeing the end of this rate hiking cycle. Interest rates, of course, move in cycles. Since we've been going up, it's only reasonable to expect them to come down in the not too distant future. But keep in mind, do not buy into the idea that when rates fall, house prices will always rise. Let me remind you about the great financial crisis and the years after, where we had rates falling and home prices falling. And if you really think about it, this makes perfect sense. If we see the rate cutting cycle start to begin, if we see the Fed and the central banks around the world start to reduce the interest rates, are you going to immediately rush into buying a property? Or if you're sat on the side looking to acquire some property, are you going to patiently wait for another year and a half, maybe even less, for the rates to come all the way down to the bottom of the cutting cycle and then go and scoop these properties up when money is close to being free to borrow again. Of course, you're going to wait. It makes perfect sense. Nobody waits for just one 25 or 50 basis point cut and then jumps in and buys a property. So whilst there's light at the end of the tunnel, it's likely that we are going to see this decline in real estate across the board, across the world, and that it's likely going to be persistent for some time whilst rates come back down to much more manageable levels. So I think the cracks are visible. I think not only are the cracks visible, but in many areas, these are starting to become absolutely an undeniable reality. The property market is clearly stressed. The aggressiveness, the velocity with which these rate hikes have been undertaken worldwide are clearly putting a lot of stress on the property market and on mortgage owners around the world. To be clear, I'm not calling for an imminent crash in property prices. I'm just pointing at the cracks in the system and saying they look like cracks to me. Likely, this will continue for some time. I am of the opinion that we're not going to see any true decline in property prices until we get towards the end of this year or even Q1 of next year. But I do believe by the time we roll around to Q1 of next year and I make another one of these videos, it's likely that we're going to be significantly more able to see that the top in the property market has come in and that we are likely on our way to make a large decline in the real estate market. Great news for first-time buyers, not so good news for people that are over-leveraged on their mortgage and struggling already with interest rates. If you have anything to say, let me know in the comments. I'd love to hear it. And for a bit of bonus content, here is the most interesting real estate chart of all. Here's US real estate, home prices versus Bitcoin. Bitcoin continues to be the exit. Bitcoin continues to outperform real estate, and houses continue to get cheaper over time, priced in Bitcoin. I'm your boy Camel. If you found value here today, hit that like button. And in the meantime, take care from me. All the best. Cheers. Bye.